Reported net income plummeted by more than half. I mean, in the first quarter of 2025, it was 94 cents a share.
Right.
But fast forward to this quarter, Q1 2026, and that number drops to just 45 cents per share.
Yeah, it's a terrifying headline number, honestly.
Oh, absolutely. Like if you
Yeah.
are holding shares of a company and you see a drop like that in your news feed, you're probably, hitting the panic button.
We are totally conditioned to do that. You read an earnings report, you hunt for the earnings per share, and you just make a split-second judgment.
Yep.
A 50% drop usually signals that a business is just, well, fundamentally broken.
But the reality hidden beneath that terrifying headline is exactly why we are here. Welcome to this deep dive.
Glad to be here to unpack this one.
We've customized today's mission specifically for you, the listener, because you want to understand the machinery underneath the numbers.
Oh.
We are unpacking the Q1 2026 earnings report and the investor presentation for First Merchants Corporation.
Ticker symbol FRME for those following along. Right. They are the largest financial services holding company headquartered in central Indiana. And today, we're going to show you how a quarter that looks like a massive stumble on paper.
It really does look bad at first glance.
It does. But it actually reveals a regional bank running a rather brilliant, ruthless balance sheet optimization.
Yeah, and to understand the audacity of what First Merchants pulled off this quarter, you really first have to grasp the sheer scale of the operation.
Set the stage for us.
Well, this is not a tiny community bank where a couple of, bad loans derail the whole year. As of March 31st, 2026, First Merchants is sitting on $21.1 billion in total assets.
Now!
Yeah. They hold $15.3 billion in loans. They're managing $16.5 billion in deposits, and they operate across 127 banking centers.
And that's spread throughout Indiana, Michigan, and Ohio. Right?
Exactly. It's a massive footprint.
So an institution of that size doesn't just lose half its earning power overnight without a very deliberate mechanical reason.
Right. You don't just misplace that kind of money.
Exactly. We are talking about billions of dollars in motion. So let's cut right through the accounting noise and find out where that missing money went.
So the earnings release shows a reported net income of $27.7 million. But that number is, it's weighed down by two massive intentional financial hits.
Okay, so it's intentional.
Very intentional. When you strip away those specific items, the bank's adjusted net income for the quarter is actually a remarkably robust $63.1 million.
63.1 million, yep.
Yep, that comes out to $1.03 per share.
Which means the core engine of the bank didn't stall at all. I mean, they actually beat last year's 94 cents.
Yeah, the underlying business is running hotter and faster than before.
So we have this gap between the 45 cents they reported and the $1.03 the core business actually generated. Let's dig into the first bucket of missing money.
Right, which is $17.0 million in acquisition-related expenses.
That is a hefty sum.
It is, but it's entirely standard when a bank of this size swallows another institution. When you finalize an acquisition, the bills just come due immediately.
Like what kind of bills?
Well, you're paying out severance packages to redundant executives, for one.
Makes sense.
And you're paying heavy penalty fees to terminate duplicated software and vendor contracts. Plus, you're funding a small army of lawyers, auditors, and integration consultants.
I always look at that $17 million like the brutal upfront cost of buying a fixer-upper house.
That's a great way to put it.
You know, you are renting dumpsters, ripping out old wiring, paying contractors. Your bank account takes a massive hit that first month, and you look temporarily broke.
But you aren't actually poor.
Right. You just traded liquid cash to upgrade your foundation.
And that foundation upgrade was the First Savings Financial Group acquisition, which legally closed on February 1st.
And this wasn't a minor expansion.
Not at all. By absorbing First Savings, First Merchants added a staggering $2.4 billion in assets to their balance sheet in one fell swoop.
That is huge.
It includes $1.8 billion in new loans and $1.7 billion in new deposits.
I want to pause on those deposit numbers because looking at the geographic footprint, this acquisition completely reshaped their leverage in a very specific area.
It really cemented their absolute dominance in the southern Indiana market.
Right.
Think about the pricing power that comes with that. With the First Savings acquisition, First Merchants is now the undisputed #1 bank by deposit rank in southern Indiana.
Number one.
Number one.
Right.
They hold $1.5 billion in deposits and $1.7 billion in loans just in that specific region alone.
So when you are the dominant player in market, you don't have to scramble and offer irrationally high interest rates to attract local business, right?
Exactly. You're the default choice.
And they are moving aggressively to finalize that dominance. The actual technological and system integration, migrating all those new customer accounts, updating the mobile banking apps, switching out the physical branch systems.
Yeah, it was a huge undertaking.
Oh, massive. But that is slated to be fully complete by the second quarter of 2026.
Which brings us to the second and much larger bucket of missing money from that terrifying headline number.
Right, the second hit.
The $17 million in acquisition costs makes logical sense. But the next item is where casual investors get completely lost.
I know I did it first.
First Merchants recorded a massive $29.8 million mark-to-market loss on a portfolio of mortgage loans.
I legitimately struggle with this concept, and I know a lot of people reading financial statements do too.
It's definitely tricky.
Help me understand why a bank sets nearly $30 million on fire voluntarily. Like, you have a portfolio of mortgages where homeowners are paying you every month. Why intentionally take a massive loss on your own assets?
It feels incredibly counterintuitive until you run the long-term math.
Okay, walk me through the math.
First Merchants isolated $357 million worth of mortgage loans sitting on their books. The fatal flaw with these specific loans is that they had an average coupon, meaning the interest rate the homeowner is paying the bank of just 3.46%.
Oh, wow. In the economic environment of 2026, 3.46% is basically a rounding error.
Yeah, it's dead weight. It
Yeah.
is trapped capital.
Right.
The bank has $357 million locked in a vault, basically, and it is only generating a tiny trickle of revenue. If they do nothing, they are stuck holding those low-yield loans for the next 10, 15, or 20 years.
That seems awful for business.
It is. So management made a highly aggressive capital allocation choice. They took those loans and formally reclassified them on the balance sheet as held for sale.
And I'm assuming accounting rules dictate that the moment you say, I'm going to sell these, you have to price them at what they're worth today, not what they were worth when you originated them.
You hit the nail on the head. Because interest rates have risen so much, a mortgage yielding only 3.46% is worth significantly less to a buyer today.
Got it.
Marking those loans down to their current lower market value triggered that $29.8 million paper loss.
Right, the paper loss.
But here's the genius of the move. By taking that accounting hit right now, they can sell off the entire portfolio in the second quarter and get roughly $327 million in hard cash handed right back to them.
Okay, the light bulb just went on.
Yeah.
They take a one-time punch to the gut to liberate hundreds of millions of dollars. They stop earning a measly 3.46% on that money, take the cash, and immediately lend it back out to commercial clients at, 7, 8, or 9%.
Exactly. The payback period on that $30 million loss is remarkably short when you redeploy the capital at double the interest rate.
That is brilliant.
It is a masterclass in long-term thinking. They accepted a temporary, ugly bruise on their Q1 earnings report to secure a permanent structural advantage for their profit margins going forward.
That perfectly explains the messy EPS number. Between the acquisition costs and liberating that trapped mortgage capital, they essentially just cleared the decks.
They did.
But there is another piece of data in this report that looks like a massive red flag at first glance, and it involves their deposits.
You're looking at the linked quarter deposit decline.
I am. We just established that they absorbed First Savings and brought in $1.7 billion in new deposits.
Right.
But when you look at their organic deposit numbers, like how their overall deposits changed from the end of Q4 to the end of Q1, the data shows an annualized drop of 13.1%.
Yep, a steep drop.
In absolute dollars, their deposits shrank by $499.4 million. $500 million walked out the door. My immediate thought is, are customers fleeing? Did the acquisition spook people?
A skeptical analyst would absolutely zero in on that $500 million drop. But this is where we have to differentiate between the raw quantity of deposits and the actual quality of those deposits.
Okay, quality versus quantity.
Exactly. This wasn't a mass exodus of loyal customers. It was a targeted, intentional purge of expensive funding.
How does losing $500 million make a bank stronger?
Well, when First Merchants acquired First Savings, they inherited the entire balance sheet, the good, the bad, and the very expensive.
Makes sense.
A significant chunk of that expensive funding came in the form of broker deposits. During the quarter, First Merchants deliberately paid off $185 million in broker deposits that they inherited from First Savings.
I've always viewed brokered deposits through the lens of Uber surge pricing.
That's a good analogy.
Right, like
Yeah.
when a bank desperately needs liquidity, Maybe loan demand is skyrocketing and they don't have enough cash on hand. They pay a premium to a third-party broker to flood them with cash quickly.
Yep.
You get the ride you need, but you are paying triple the normal rate for it.
The surge pricing analogy is perfect. Broker deposits are often referred to as hot money in the industry.
Hot money.
Yeah, the people providing those funds have zero loyalty to First Merchants. They're simply chasing the absolute highest yield available nationwide.
Right, they don't care about the local relationship.
Exactly. It is the most expensive way a bank can fund itself. Because First Merchants is sitting on a $21 billion mountain of total assets, they simply didn't need that expensive surge pricing money anymore. So they paid it off. They closed out the accounts.
So it wasn't a leak in the boat. They were intentionally bailing out the toxic water.
And we can prove that this strategy worked by looking at their ultimate profitability scorecard,
Which is what?
the net interest margin. Specifically, they report their net interest margin on an FTE basis.
Let's pause right there. The report relies heavily on this FTE basis metric. What does that actually mean for the listener trying to decipher these financial documents?
Sure. FTE stands for fully taxable equivalent.
Okay.
Banks hold a wide variety of assets. Some are regular commercial loans where the bank pays taxes on the interest they earn.
Right, normal loans.
But banks also hold a lot of tax-exempt investments, like municipal bonds. To fairly compare a tax-free bond against a standard taxable loan, accountants mathematically adjust the tax-free yield upward to show what it would earn if it were taxed.
Ah, I see. It creates an apples-to-apples comparison across the entire balance sheet.
Exactly. It gives you the truest picture of how effectively the bank is generating profit from its assets. And despite all the noise of the quarter, their net interest margin on an FTE basis actually increased.
Wait, it went up?
Yeah, it increased by 6 basis points, rising to 3.35%. Management explicitly stated this increase was driven by optimizing their funding costs.
Wow.
They shrank their total deposit base by letting the hot money go, but the deposits they kept are vastly more profitable.
It's addition by subtraction. By getting rid of the expensive surge pricing deposits, the overall profit margin of the bank goes up, even as the total deposit number goes down.
It really is fascinating balance sheet gymnastics.
It is, but, financial gymnastics only take you so far. Acquisitions and deposit optimizations are crucial, but if your day-to-day legacy business is stalling out, you are just masking a deeper problem.
Oh, totally. You can't just spreadsheet your way to long-term success.
Right, you actually have to sell banking services to real people. Let's pivot and look at how their core operations are performing out in the wild.
Well, the organic growth numbers are incredibly strong.
Let's hear them.
If you completely exclude the massive injection of loans from the First Savings acquisition, and you exclude that $357 million mortgage portfolio they reclassified to sell, First Merchants still grew their loan book organically
By how much?
by $768.0 million over the trailing 12 months.
That is a 5.9% organic growth rate. In an economic environment where borrowing costs are high and many businesses are scaling back expansion plans, growing your loan book by nearly 6% organically is a massive flex.
It really points to a very specific, disciplined playbook. They categorize their growth engine into 4 strategic pillars.
Okay, what are they?
They have commercial banking, consumer banking, private wealth advisors, and mortgage banking. But rather than just viewing these as separate departments, it helps to see how they interact to protect the bank.
Let's bring that down because I think people assume all a bank does is take deposits and make loans.
Right. Their commercial and consumer divisions are deeply intertwined. They describe their approach as high-touch relationship banking.
High touch.
Yeah. They are attempting to blend high-end, sophisticated digital capabilities with genuine local market connectivity. They aren't a faceless mega bank operating out of a skyscraper in New York.
Sure.
Their commercial lending officers know the local manufacturing plant owners in Indiana and Ohio personally.
But the pillar that really caught my eye in this report is their private wealth advisors division.
It's a standout for sure.
They are boasting $6.0 billion in assets under advisement, which includes $4.2 billion in actual assets under management. Why is wealth management such a critical piece of the puzzle for a regional bank like this?
Wealth management is basically the holy grail of revenue diversification.
Really? How so?
Now, traditional lending is inherently cyclical. When interest rates spike or a recession hits, loan demand dries up, and the risk of borrowers defaulting goes way up. It is a high-stress way to make money.
That makes sense.
Wealth management, on the other hand, generates steady, recurring fee income.
So they're charging a percentage fee to manage that $6 billion, regardless of whether loan demand is up or down.
Exactly. And crucially, wealth management adds zero credit risk to the bank's balance sheet.
Ah,
If the stock market drops, the fees might dip slightly, but the bank isn't on the hook for bad loans. That fee income acts as a financial ballast. It keeps the bank's revenue stable during turbulent economic storms.
Speaking of navigating economic storms, when I look at the execution of this quarter, absorbing a massive competitor, completely restructuring the mortgage portfolio, dumping toxic deposits, and maintaining organic growth, it requires a remarkably steady hand at the wheel.
It really does. The tenure of the executive leadership team is perhaps the most underrated asset First Merchants has.
I would agree.
This is not a group of hired guns who bounce from bank to bank every 3 years, chasing stock options.
The longevity is almost unheard of in modern corporate finance. Like CEO Mark Hardwick has been at First Merchants for 28 years. He started there in 1997.
Yeah, that's rare.
And the CFO, Michelle Kalyecki, has been there 11 years, bringing 37 years of total banking experience to the table. President Mike Stewart has been at the bank 18 years. Chief Credit Officer John Martin, 18 years.
Think about the psychological impact of that shared history.
Right.
This core group has sat in the same boardroom together through the dot-com bust, the 2008 Great Financial Crisis, the pandemic, and the recent massive spikes in inflation. They understand each other's risk tolerances implicitly.
They aren't trying to impress Wall Street by taking wild existential risks for short-term gains. They are building a fortress.
And the data backs that up, specifically in their credit quality. When you look at their non-performing assets compared to their total assets, it is sitting at a microscopic 0.43%.
Let's define non-performing assets for a second, because 0.43% sounds low, but context is everything.
Right, so non-performing assets are essentially loans that have gone bad. The borrower is so far behind on their payments that the bank has to classify the loan as fundamentally at risk. In many cases, it includes non-accrual loans.
A non-accrual loan meaning the bank has literally stopped recording the expected interest as income because they are so doubtful the borrower will ever pay it.
Correct. They just freeze the accounting on it. For a bank with a $15.3 billion loan portfolio, having only 0.43% of assets fall into this troubled category is proof of an exceptionally clean, conservative underwriting process.
Most impressive.
Their chief credit officer isn't rubber-stamping risky deals just to show loan growth.
The report actually highlights a detail that proves how tenacious they are about protecting their capital. This quarter, they recorded an interest recovery of $1.2 million.
That stood out to me as well.
Yeah. They successfully resolved a non-accrual commercial real estate loan that had previously gone bad, and they managed to claw back over $1 million in interest.
In the current climate, commercial real estate is basically the boogeyman of the banking sector.
Oh, 100%.
Many regional banks are quietly taking massive write-downs on commercial properties and just walking away from the wreckage. For First Merchants to take a dead commercial real estate deal, work it out, and actually recover $1 million shows a level of operational grit you just don't often see.
And that operational grit generates a massive amount of excess capital, which brings us to how they're treating you, the shareholder. Because the ultimate sign of a management team's confidence in their own fortress is a stock buyback program.
Without a doubt. Year to date, First Merchants has aggressively repurchased 708,856 shares of their own common stock.
That's a lot of shares.
They returned $27.6 million directly to shareholders just in the first few months of the year.
You don't spend nearly $28 million buying back your own stock if you think there are cracks in your foundation. You only do that when you believe the market is undervaluing your true strength.
Exactly.
And even after spending that cash, their capital levels remain incredibly robust. The report notes their Common Equity Tier 1 capital ratio is sitting at 11.22%.
The Common Equity Tier 1, or CET1 ratio, is the ultimate measure of a bank's financial strength.
Explain that for us.
It compares their absolute bedrock capital, the money that basically cannot be withdrawn by depositors, against their risk-weighted assets.
Give us a baseline for that 11.22% figure. What are regulators usually looking for?
Regulators generally require a minimum CET1 ratio of around 7% to be considered adequately capitalized. First Merchants is operating at 11.22%.
So they have plenty of cushion.
Think of it like wearing financial Kevlar. They have so much thick protective armor built up that they can comfortably absorb a major acquisition, buy back $27.6 million of their own stock, and intentionally swallow a $30 million accounting loss on mortgages, all simultaneously.
And all without ever putting the bank's core stability at risk.
Exactly right.
That brings our journey full circle perfectly. We started this deep dive staring at a terrifying headline. We saw a catastrophic drop in earnings per share that would send most casual observers running for the exits.
But once we cut through the noise, the narrative completely flipped.
It really did.
We accounted for the $17 million in standard acquisition costs. We analyzed the strategic brilliance of a $30 million mortgage restructuring designed to unlock hundreds of millions in trapped capital.
And underneath those one-time upfront costs, we found a $21 billion regional powerhouse. We found a leadership team actively expanding their profit margins, deliberately shedding toxic hot money deposits, aggressively growing a wealth management ballast, and totally dominating their Midwestern footprint.
It's quite the turnaround from that first glance.
It really is.
As we wrap up, though, there is one final forward-looking detail to consider. It goes back to that massive mortgage sell-off.
Right, to $300 million.
We discussed the logic behind First Merchants taking a painful, highly visible $29.8 million upfront loss to get rid of 3.46% yielding mortgages. They did that to free up over $300 million in liquid cash right now.
They cleared the decks with a very specific intent.
Right. So the question you have to ask yourself is, what are they hunting?
Ooh, I like that.
If a deeply conservative, veteran-led regional bank, a team that survived the 2008 crash together, is willing to take a public hit to build a $300 million war chest today,
Yeah.
what highly lucrative, high-yield opportunities do they see coming down the pipeline over the next year that the rest of the market might be completely missing? You don't stockpile that much dry powder unless you have a very clear target in mind.
But that is an incredible thought to leave on, because as we saw today, the math in these earnings reports is never just binary. The headline number rarely tells the whole story, and sometimes the mess of a massive restructuring is exactly what creates explosive long-term value. Thank you for joining us on this deep dive. Keep questioning the headlines, look for the underlying mechanics, and we will catch you on the next one.